Welcome to TMS Insights, the first edition for 2023. Happy New Year, Ben.
And you,
That's
Jessa?
it. Back at the desk working hard.
Yeah.
It's been a nice Christmas and New Year break for everybody, we hope, and we're here to get into the year ahead. But Ben, when we actually do the count for the tail of the ticker for 2022, it was a negative year for a number of parts of equity. So the Australian market down roughly 5%. And a lot worse in the US market.
Absolutely.
And certain sections. Not everything was across the board the same way. So, when we reflect on that, that's been a difficult year.
Yeah. Look, I think, the resources were obviously the part of the Australian market that really saw our market significantly outperform. I think actually the Australian market was the best performing market globally last year. Canada, I think, was just behind because they're also pretty resource heavy. So, BHP is 12-13% of the index these days. It had a cracking year, paid a big dividend, as did, your Rios, Fortescues, et cetera. So
and the last quarter was particularly strong for those. They had 28% Rio at the end of last year. So that was a big positive, wasn't it?
It was a big positive. Certainly if you look at the States, it was a grim picture. The NASDAQ had its fourth worst year on record. It was down 35% for the year.
Yeah.
I think the S&P was down mid-20s, something like that, by the end of the year. But look, and the resources have had a kick along to start the year because I think the big piece of news that's come out that wasn't priced into the market before Christmas was China.
The reopening of the China trade. So,
it's just extraordinary.
Well, it's a major number 2 economy. So, it's having an impact there. And this is the part everybody goes through. And we know the reasons. We explained them last year. We talked at length about why, with an interest rates sea change going on through 2022, why growth investments underperform. But the flip side of this is what can go right. Now, there's one example, the China reopening trade, that last time we did a video in December, that wasn't accounted for.
No. Well, President Xi stood up at his next 5-year inauguration, I think 3 weeks ago, and said, or 4 weeks ago, and said, the fight against COVID will continue, it will be long, it will be hard, and the Chinese people will prosper. 3 weeks later, their borders reopened and virtually every person in the country's had it. I mean, it's quite mind-boggling how quickly they've turned on that. Yeah. And obviously resources are going to be a winner. Their economy has suffered greatly because of this zero COVID. The government's going to want to start to spark the economy back to life now. But there's other winners as well, like, Auckland Airport travel there's some other things that people might have that could really benefit this year.
Have kicked along and may do yet. And all this points to this macro story, which going, back to this interest rate thing, the part that we're picking up on at every data point, and there's quite a bit of data out this week globally, in Australia and US and globally, and we saw some last week in the Euro region. We did talk about this with clients last year, how many of the factors driving inflation we were seeing them dip away at the end of last year. Now we saw that the Euro numbers were very good in terms of end of year inflation numbers being a lot lower. They're still cycling high 12-month numbers.
Yes.
But on Thursday night our time, we get data out of the US on CPI.
Yeah. And I think because, to me, the market is starting to wake up to this, and I think we're starting to see, the NASDAQ start to go. We're starting to see some of the interest rate sensitive areas get a bid. Yeah. And it feels like the market is starting to sense that inflation is normalising potentially quicker than expected. I mean, you sent around a great email, thought, and we could send the email to any clients that are the article. But if you look at the last 12 months in America, the average inflation rate was, I think, 5.6%. But for the first 7 months, it was 7.8%. And for the last 5 months, it was 2.4%. Yeah. So, extrapolate forward, assume that last 5 months continues. It's going to be up and down a bit, but, you don't have an inflation issue.
That's actually exactly where they want it. Yeah. So the last few reads have been exactly where the central banks want it. It doesn't mean that they won't have potentially a couple more rate rises, but you're seeing the end of that. And that's the part that excites the market. And when people ask what could go right, you've had a bad year across a number of asset classes. What can go right here is the end of the factors that drove that, and they just ameliorate the downside. And what you see is this expansion in the PE.
Yeah.
And now we're coming into earnings season.
Yeah.
Earnings start this Friday in the US.
Yeah.
We're a few weeks away for the February reporting season here. But earnings will be in focus.
Yeah.
I'm not concerned about them here, Ben. I think the February reporting season will be fine here.
Yeah.
We'll probably have a different look through parts of the year, perhaps. The US was pretty critical, though, on an earnings side. And what I'm hoping, though, Ben, is that we see reasonable earnings, see PEs expand.
Yeah.
And that's the chance for markets to have a good 23.
Absolutely. We know that a number of the indexes in America are trading on PE multiples that we haven't seen in years. You know, I think if you look at the S&P 500, you got to go back 7 years to see the last time it traded on this kind of multiple.
Yeah.
And it's because of what rates have done, but it's also because everyone's got very negative on earnings.
Yeah.
So,
and perhaps too much so. I think, it's not going to be economically a roaring year. We've had good years the last 2 years. So the economy's, when we've got locally 3.4% unemployment, it's hard to continue to see lower unemployment levels. It's very hard now.
Yeah.
So it could actually tick back up. We shouldn't be concerned by that. We know a lot of noise around the word recession comes up, and the UK, for example, is already ticked that box, really. Europe probably the same. But my base case scenario, Ben, is I'm not convinced that the US will go into a recession, and I don't think that's the case here at all. It looks like it's going to be a lot more mild, but a bit of a slowdown nonetheless.
Yeah, definitely. I think that the unusual thing that's going on at the moment is the central banks, particularly the Fed, are still talking a very tough game despite the things that we're discussing.
Yeah.
And that's because they want to keep inflation in the box. They feel...
And they need to tell people with their words about concerns.
Right. So every time we're seeing a bit of a bounce in the market, a Fed voting member comes out on CNBC or Bloomberg and says, we've got some ways to go yet, we've still got more work to do, They want to create some short-term pain to well and truly clamp down on this problem.
Yeah.
And then it's probably a 2024 story where you start to see rate cuts in America. I think that's the bond market in the US is now pricing that in. And the equity markets, don't forget, will start to price that in the second half of this year.
That's right.
As they approach.
And even being comfortable where they're going to settle is okay too. So the game comes back to earnings. Ben, just other things for other areas when you look at this, a couple of parts of the market. We talk about bonds, we could talk about REITs, which are property trusts. Tough year last year, could be a bounce back area.
Yeah, because there's not a lot of stocks to talk about today because we really haven't had any company news since November or December. But, it is an area I think clients could start to have a good look at because the listed property trust sector fell nearly 25% last year.
Yeah.
And, now offering very strong dividend yields.
Yeah.
We know that the market has effectively priced in a significant drop in the valuation of various commercial property classes, industrial, shopping centres, office, etc., etc. There's no doubt that's going to happen. But if we are close to the peak in the interest rate cycle, we've potentially seen a lot of that repricing already happen.
Yeah.
The repricing of the assets, that'll be a this year's story, but the market's already in the share prices priced that in. And maybe, the price of these assets don't fall as much as what the market's expecting them to, and you get a bit of a meeting of the...
it's overreacted on the downside and it works its way higher and total returns could be quite good.
Well, it's another area where, you're now quite, conservatively looking at 6.5% to 7% yields.
And if you only revisit half of the loss of last year on capital, that's 10%.
Yep.
You talk a total return of 16 or 17%.
Right.
So these are the numbers that can drive good returns to your portfolio.
Yep.
And it's just by looking at it with a balanced sort of point of view.
Yeah.
Not putting all your assumptions around one case.
Yeah, it's not a trade.
No.
It's an area I think probably quite a few of our clients are quite underweight, I would suspect, versus, your big industry super funds, etc. massive exposure to commercial property.
Yeah.
And this is the time you want to get interested because the market's
Exactly.
depressed the pricing significantly.
Yeah, exactly. Okay, well, we hope everybody's had a restful start to 23. Those on holidays still enjoying it. We'll be back bringing you an update in the first part of February for reporting season, and we'll do a second one later in that month as well. But that's all for today.